Hi there, welcome to Kneppy Invest and welcome to a Boxing Day 2024. Hopefully Santa Claus was kind to you and did not leave any coal in your stocking. But even if he did, that's better than what happened to me. He completely bypassed my house. In fact, he probably looked down at my house and went, "You don't need anything, Neppy. You're fine as you are." And to be honest with you, I am. I'm completely fine with what I have. I don't need presents to validate my life or presents to make me happy or more happy. Just being alive is enough for me. And to be honest with you, if I take this down a bit more of a philosophical angle, if you just think, if any of your ancestors made a different choice, it could have been a very simple different choice, could have been something big. But if they made one different choice in their life, there's a chance, a pretty big chance, you probably weren't born. So the way to think about it is just being alive is a big lottery win. Unless you don't like being alive, you don't like life, then it's a complete opposite. Okay, so that's all I'm going to talk about when it comes to philosophical discussion. Just being alive is or feels like a win or lottery win for me. And that's why I'm happy. Now, something else that makes me happy is investing. And unfortunately, the markets has been closed the last few days because it's public holidays, Christmas and Boxing Day. So I've been thinking I've got a bit of spare time on my hands. I'm not working at the moment. So I thought, why not develop a high quality screener? Now, I've been thinking about this for a while. I've tinkered with screeners in the past, but I really want to focus on developing a high quality screener. The reason behind that is simple. I want to broaden my horizons. And the reason I say that is at this particular time, through my superannuation fund, I am investing in high quality companies. In fact, the majority of companies in my super fund right now are high quality companies. Companies that more than likely I won't trade or sell in the near term, at least the near term. But I want to hold those companies as long as possible just to, and that's the reasons behind that. Compounding, and I think trading high quality companies, I have found it's just better to hold them for the long term because the share price keeps going up. So I want to find more high quality companies through the world. I want to broaden my horizons because I only invest in ASX, New York Stock Exchange, and NASDAQ companies. And through my super fund, I invest in numerous exchanges throughout the world. Now, I should also say I've also invested in one German company and one Danish company, but I want to increase my pool of high quality companies. And I thought the best way to do that is to develop a high quality screener. Now, there are some characteristics of high quality companies that you can't screen for. They're more qualitative, say maybe quality of management, that sort of thing. So you can't really do that. So these are all quantitative things, quantitative characteristics that you might consider that belong to high quality companies. Now, I am subscriber to two sites that have screeners, FinChat and Ticker. So I did try to develop screeners through both of those platforms. Not satisfied with Ticker, a little bit limited or more limited than I wanted. And there was a few things that it wouldn't allow me to do. So I'm focusing my attentions on FinChat. And over the last 36 hours plus, I have developed a screener that I do like. And I thought, why not do a video on this screener? Because I had no idea what other video I should do today. So this is my high quality screener. Now, more than likely, this particular screener will change over time. I want to refine it, that sort of thing, and I do expect it to change. But what I'll do is I'll go through this screener, talk about all the filters I'm using, maybe I'll talk about why, that sort of thing. Okay, the first one in FinChat, you have to put a country. Now, if you don't put any countries here, it doesn't exclude any countries. I don't know why you have a country here, and the reason behind that is because you can filter via you can filter the exchange. So in this particular filter, all I'm looking at is companies that are listed on the ASX. Now, I'm not sure if it's a bug, but this particular screener, I'm not sure what it is filtering out one company, ResMed. I don't know why, but ResMed is listed on numerous exchanges. So that means I need to list numerous exchanges so it doesn't filter out ResMed. So that's interesting. I'm not sure why exactly yet it's filtering out ResMed, but it is. So these particular filter right now, or this particular screener right now, is only limited to ASX. Now, if I want to include New York Stock Exchange, I can do that, or just limit it to New York Stock Exchange, I can do that as well. But I just wanted to limit it to one exchange at a time. And the next one is I've excluded mining energy companies. The reason behind that, I don't believe, in my opinion, mining and energy companies are high quality. The closest to a high quality company in mining, in my opinion, again, is BHP. And I don't think, I'm at the point where I don't think BHP is the sort of company you own for the long term. It's more of a sort of medium to long term trade. So this list of high quality companies does not include any mining companies. Okay, so let's have a look at some of the what they call metrics in FinChat. So quite a few here. So we'll start off, actually won't start off at the beginning because this is total return since inception. It's something I included towards the end. We'll start off with the first metric I put in place. And this is something I use when I am first or researching or looking at a company. The first thing I look at always is revenue growth. Is the company growing revenue? Now, I do prefer revenue per share growth. They do not have that in FinChat. So I'm just looking at the revenue growth, CAGR revenue growth over the last 5 years. I sometimes will look at 10 years, but at this point, I'm just looking at revenue growth over the last 5 years, and that needs to be greater than 5%. Now, I have been thinking of increasing that to 6 or 7%, and there are reasons behind that, which I'll get into this video. So what I'll do is I'll show you my screener setup, and then we'll have a look at the companies that it did filter. So 178 companies on the ASX, not a lot at all. So revenue growth, at least 5% per year over the last 5. Can use over the last 10 years, 5% as well. Diluted earnings per share. Now you notice I have not put any number there. I just want to see if the company has increasing earnings per share. So I didn't want to use this as a filter. I just wanted to put down the number. So just display. I think they call it just display. So I just wanted earnings per share displayed over the last 5 years, CAGR again. I just wanted to return equity 10-year average to be displayed. Now this, in the ideal world, should be a filter. But there are some companies that had just a dash because they have not been listed for as much as 10 years. WiseTech is a great example. Hasn't been listed for 10 years, so return equity comes back with a dash. And I did put 10% here and eliminated WiseTech. So what I want to do is, for this particular screener, not to eliminate companies like WiseTech. I don't mind if it includes companies that I would not consider high quality. And I'll talk about that when we go through the list of companies. So instead of putting a limit there, a greater than 10%, I just left that as blank. I just wanted this to be displayed. So that's a 10-year average. I also included free cash flow yield. This is more of a valuation as well with P ratio. I just wanted the yield and the P ratio just to be displayed. Dividend per share, 5-year CAGR. This is one I could exclude, but I just want to see which companies don't have dividends or haven't been paying dividends all that long. And I just want to see which companies are growing their dividends. Now, maybe I could put 0% here. So only focus on companies that are growing their dividends. But again, that would exclude companies that don't pay dividends. And that would exclude Berkshire Hathaway. And I would consider Berkshire Hathaway to be high quality. Okay, gross margin above 30%. So this was, I was thinking of companies that might not, that might have gross profit margins below 30% that I might consider high quality. And there is one company out there, Costco. So I was thinking of leaving that blank, but when I put 30% in there, it did filter through, away many companies that I would not consider high quality. And I just wanted to see the 5-year average of gross margins, and then I can compare that to the gross profit margin in the past year. The reason I've done that is I just want to see if gross margins in the last year was higher or lower than the 5-year average. And the reason I want to do that is because I do most of the time, after I look at revenue growth, I look to see whether gross margins are increasing or decreasing. And again, there is no screener, whatever you call it, metrics in FinChat when it comes to gross margins increasing or decreasing over the last 5 years. So that was sort of my proxy for that particular metric. Now on to the last one, and this is probably the most interesting one. I did not expect to have to include this particular metric or filter, and that is total return since inception. And I put minus 10%. In fact, I did initially have 0%. Now, when I ran the screener without that particular filter, I noticed a lot of really small, crappy companies were popping up. Companies that have seen their total return decrease 80% over the last 10 years, down maybe 10% per year. And when I put this particular filter in there, it magically got rid of all those companies. So this actually makes sense. If you think about high quality companies, the share price of these companies and return of these companies over a certain period of time should be going up. It should be increasing. So originally I did put 0, and then I thought it might filter out a few companies that may not have been filtered out. So I was being a little bit conservative, putting minus 10 there. Okay, so I do like this particular screener at this point in time, but I do think I will more than likely tinker with it, and I wouldn't say to perfect it. I'm not sure if I could ever perfect it, but at this point in time, it's done a pretty good job. Okay, so let's have a look at all the companies that is included in this particular, screener. And what I'm going to do, and this, by the way, is listed by market cap. What I'm going to do is compare it to ASX companies. So you'll notice at the top of my screener, we have CSL, but Commonwealth Bank of Australia is not included, and BHP is not included. Well, BHP, it's a mining company. CBA is not included. So CBA was not successful in one of my filters. More than likely revenue growth. That's what I'm thinking with CBA. So CSL is the biggest high quality company on the ASX, and I've always believed that. I've always believed CSL is the biggest high quality company on the ASX. Then we have NAB, Westpac, ANZ filtered out. More than likely, probably because of revenue growth or the lack of revenue growth. Macquarie Group, this is the interesting one. Macquarie Group was not included. Now, on one of my first renditions or editions, it was included, but it did not satisfy one of my filters. I'm not sure what that is, but Macquarie Group is a company that I've always struggled with in terms of quality. I know a lot of experts out there, a lot of retail investors would consider Macquarie Group to be high quality. I am not so sure. So I'm okay with Macquarie Group not being included in this particular filter. Then Wesfarmers. Yes, Wesfarmers is the second biggest high quality kind of company on the ASX. Goodman Group is not included. Yes, Goodman Group. And I would say a lot of people out there would consider Goodman Group to be high quality. So more than likely that would be maybe margins, gross margins less than 30%. Could be. Anyway, and then we have Fortescue, not included. Telstra Group, not included. No surprises there, particularly Fortescue because it's mining. Woodside, and then we get to Aristocrat, the third biggest high-quality company on the ASX. No surprise there. And then we have Rio Tinto, Transurban, then WiseTech. Yes, WiseTech comes in at number 4. Woolworths is not included. Not surprised there. More than likely because of revenue growth. Then we have REA Group. Now I'm just going to say something right here. So if you just have a look at the top 5 companies, I've invested in CSL, Aristocrat, WiseTech, and REA Group, and I do consider those 4 companies to be high quality. The only one I have not invested in is Wesfarmers, and that is definitely on my watch list. That is definitely on my watch list. And I will buy Wesfarmers if it gets down to a price that I think it's good value. Now on to probably the first surprise, Brambles. Now Brambles comes just behind QBE Insurance. So QBE Insurance is not in my high quality screener. So let's have a look at Brambles. So this is the first one I really went through. So let's have a look at some of the numbers here. So total return since inception, 8.1%. If you have a look at some of the other companies just above it, so WiseTech, 49%, REA Group, 24%, or Aristocrat 19%, Wesfarmers 15.8%, CSL 23.2%. Those are sort of returns you expect from high quality companies. 8.1%, would you be happy with that? Yeah, maybe. Revenue growth 7.12%. It's probably not as high as what I would like, but again, I mention that I am thinking about increasing the revenue 5-year CAGR from 5% to maybe 6 or 7%. Diluted earnings per share minus 9.5%. So that is a little bit of a red flag. A return on equity 10-year average 24.9. That's pretty good. I do like that return on equity. Free cash flow yield 3.8%. Price earnings ratio 22.7, which I think might be a little bit high for this type of company. Dividend per share growth 10.8. That's pretty nice. Companies increasing their dividends, and gross profit margins about 35%. And in fact, in the past year, it actually was lower than the last 5 years average. So this is the first company that was included in this particular screener that I'm unsure about. But definitely, I do know some people who might consider this company to be high quality. Okay, so let's go back to the list. Actually, I won't go through the rest of this. Actually, I will, because we get to ResMed just below 0. So the next two companies in the filter or the screener are Pro Medicus and Xero, and I invested in both of those companies. And both of those companies hopefully are long-term holds. So I considered both of those companies to be high quality. And then we have James Hardie. But you'll notice on Market Index, just before James Hardie is ResMed. So I saw this and went, where's ResMed? I looked at ResMed via FinChat, and it satisfies all the filters. I am not sure why ResMed has been excluded. So this is one thing I have to explore, because definitely I would consider ResMed to be high quality company. Okay, so that's something I did go through. I went through all the companies in the screener, and I just compared it to all the companies on the ASX by markup, and I was very happy with the screener until we get to a certain point. So if we go down the list here, we have James Hardie. It's another company where I've undenied before whether I would consider this company to be high quality. So I would definitely listen to someone who would want to argue James Hardie is a high quality company. If you just go through some of the numbers, they all look pretty good, except return on equity. It says minus 3.45%. I actually did have a look at that. If you go back to between 2015, 2017, 18, their return on equity was highly negative. But over the last 5 years, the return on equity for James Hardie has been about 20%. That's why it's negative, because the first 5 years, highly negative. And then, yeah, it looks all pretty good. James Hardie, but again, sort of company where, is it high quality? Then we have Cochlear, yes, high quality, in my opinion. Car Group, yes. Sonic Healthcare, I don't know. This is another one where I am questioning, but I would listen to arguments. ASX, after Sonic Healthcare, it's ASX, and this is one where I go, I'm not sure. But they do have a moat, and moats can be powerful, but the question I have is around management. Are they really taking advantage of that moat? And I'm probably going to say no, but they do satisfy this particular screener via the quantitative numbers. Then we have the Lottery Corporation. Now, you notice in the Lottery Corporation, a lot of blanks, because this company, has not been listed because they were spun out of, was it Tabcorp? Yeah, spun out of Tabcorp 4 or 5 years ago. So there's quite a few blanks here, or dashes. So this is sort of, what happened? That's the sort of company that hasn't been on the ASX for as long as you'd want to. That has not been, what was I going to say? The sort of company that you might consider to be high quality, but they have not been listed long enough at this point in time. So you might just want to wait, maybe, to get proof. Okay, let's go down the list. And after Lottery Group or Lottery Corporation, we have Technology One, without a doubt, high quality. And I do own Technology One. And then after Technology One, we have Telix Pharmaceuticals. And if you do have a look at some of these companies' numbers, in fact, I'm going to have to, there we go, that's better. If you have a look at Technology One and have a look at some of their numbers, where is it? Telix Pharmaceuticals, sorry. So return since inception, 63%. Revenue growth, last 5 years, 217.2%. Diluted earnings per share, 10.5%. And there's a few dashes as well. P ratio 152. Gross margins have increased from 54% for the average last 5 years up to 63%. So this company is expanding the margins, phenomenal revenue growth, and definitely a company that I think will be considered high quality company in the future. Maybe not now, but definitely in the future, because the company has not been profitable all that long. And now we get to a problem. We have some companies I definitely would not consider high quality. Okay, so Orica and Mirvac. So these are two companies. The first companies that I go, oh, I need a little bit more tweaking with this particular screener. So let's have a look at why these companies are in this particular screener. So returns, and this is pretty damning, particularly with Mirvac. So Orica return since inception 7.45%. You want higher than that. And Mirvac 4.63%. You want a lot more than that. By the way, total return, share price movement plus dividends. So includes dividends. Anyway, revenue per share growth, Orica 5.4%, Mirvac 6.12%. And I was looking at that going, oh, yeah, okay. So at least they're growing their revenue, but maybe revenue per share, maybe not all that much. And then we go to earnings per share growth. Mirvac's negative. Orica's not that bad, 11.25%. So I was thinking, maybe I'm wrong with Orica. Maybe Orica could be considered high quality. Return on equity, 2.8% for Orica. Mirvac 8.2%. So definitely 2.8% is a massive red flag when it comes to Orica. So perhaps I should have a return on equity filter. But if you look at TLX, it's blank because they're not profitable. Well, they haven't been profitable for the last 10 years. It's only been profitable for the last few years. And again, the lottery group or corporation, and you also notice Xero is negative. And also WiseTech has a blank there because, again, the company has not been listed all that long. So that's one of the reasons why I'm a little bit hesitant to putting a return on equity filter over a 10-year period. I have been thinking about return on equity just in the last year and have that as a 10, but it can filter companies that had a worse year when it comes to return on equity. And one of those companies was actually, in fact, Car Group. Car Group had a return on equity of like 9, so it would have been filtered out. Anyway, and then we have free cash flow yield, both pretty nice. P ratio, fairly low for Orica, negative for Mirvac. And then if you do have a look at dividend per share, both negative. So that is a big red flag, in my opinion. And interesting enough, both of these companies' gross profits were above 30%, which did shock me. So I need to rejig this particular screener. So both of these companies, and I want to do this. Why does it keep doing that? I must have hit the back button for some reason. So I need to just rejig this particular screener so it doesn't include those companies. I would not call both of those companies high quality. So if we keep going down the list, we have net wealth, Steadfast. Yes, I could see or consider both those companies as high quality. And then we get to Horizon. There is no way Horizon is high quality. And then if you go through some of the numbers here, return 6.1%, mediocre. So maybe that's what I need to do. Maybe I need that to be a little bit higher, maybe 8%. Revenue 5.74%. So just like Orica and Mirvac, revenue growth has been pretty low. So that's why I've been thinking of maybe raising revenue growth to maybe 5 or 6 or 7%. And earnings per share negative. Return equity pretty low as well, 8.43%. A pretty good free cash flow yield, 13.5%. So there could be value in Horizon. And then dividend per share going backwards at 6.5% per year. Again, that's a red flag. So maybe another possible filter is having dividend per share 5-year CAGR as 0. But again, that would filter out some companies like TLX, which I don't want to filter out. And what else? James Hardie, 0. And it would also filter out Berkshire Hathaway. Okay, so let's keep going down the list. So we have Hub24, Breville, Life360, HMC Capital, Reliance Worldwide. That's interesting. This is another company that I've been grappling with. Would I consider Reliance to be high quality? At this point in time, I'd probably say no. but it does come up on this particular screener. So maybe I could consider it to be high quality. Zip. I don't think I'm there yet, calling this company high quality. AUB, Super Retail Group, IDP Education, ARB, National Storage REIT, interesting. Levisa, Coden, Tours, Domino's Pizza, MFF, which is, what's that called again? MFF Capital Investments, Region, which is a REIT, PEXA, Perpetual. I don't know about Perpetual. We have Nuix, Ingenia Communities, and it keeps on going down. So interesting group of companies here. One of the reasons I wanted to look at this particular screener is just to see what really small companies are popping up. When I say really small, I'm meaning the smallest of the small. So the smallest company popping up on this particular screener is a company called Raptus, a company with a market cap of less than $1 million. So I'm going to have a look at that company just to see why it's popping up. Then we have Orion Equities, Imperial Pacific, N1 Holdings, Ambertech, Foss Capital, London City Equities, Kip McGrath, ECP Emerging, Mayfield Childcare, Verbrek, which I do own, Prophecy, which I do own, Market Limited, Cryosite, Janison, Prime Financial, I do own, Self Wealth, Boom Logistics, Sports Entertainment Group, Resource Development, Kinetico, Atlas Pearls, Laser Bond, Mayfield Group, Structural Monitoring Systems. So there's definitely quite a few companies at the lower end of this particular list that I would not consider high quality. But maybe in the future, they could be considered high quality. We have Dust Group, Cytel, Pet Makers popped up. Can't believe Pet Makers has popped up. Osco, Vita Life Sciences, Saunders, Close the Loop, Corvest, What's So Property. So an interesting group of companies, but I do want to just tinker with it so it does eliminate some of those companies I would not consider high quality. My only problem is it might also eliminate some companies that I could consider high quality. So the key is to eliminate as many local companies as possible, but not eliminate unfairly those companies that could be considered high quality, like ResMed. Anyway, that's all I have for this particular. Oh, by the way, I actually did have a look at this filter or this screener. Where I've got to show screener filters. And I did have a look. The whole reason I'm doing this is so I can simply put in New York Stock Exchange and just run screener. So 178 results. So it's not many companies on the ASX, by the way. So this one has, well, it's not 250. The reason it's 250 is because I limit the results to 250. If I limit it to 1,000, and I just going to change this to, just change that to 5. The reason I'm doing this is because for some reason, you have to make a slight adjustment. And the screen results would be probably 300 to 400. 336. This is on the New York Stock Exchange. So not a lot of results. I thought it was going to be way higher on the New York Stock Exchange. And at the top of this list is Berkshire Hathaway. Then we have Eli Lilly, Visa, MasterCard, Oracle, Home Depot, Salesforce, Abivai, Merck & Co, ServiceNow, Accenture. It's going through this and going, yeah, okay. There's a few companies here I don't know a lot about. I own Shopify, by the way. In fact, I do own a few of these companies, but let's have a look at NASDAQ. So this is one I haven't looked at yet. So I'm going to change this to 5 again and run screener. I would assume this is going to be a little bit more. I'm going to say 400 to 500. Oh, no, it's lower, 276. So it's not a lot of hits. And at the top of this list, we have Apple, shareholder, NVIDIA, shareholder, Microsoft, Apple, Amazon, Meta, all shareholders. I'm a shareholder of all those companies. The first one here is Broadcom. And I saw that and went, ooh, I need to look at Broadcom a little bit more closely. Another one here is T-Mobile US. Another company I might have to look a little bit more closely. Then we get PepsiCo, and I was like, okay. PepsiCo is interesting because, yeah, I did look at this, didn't I? Because I remember this list to perfection. Because I saw PepsiCo and I noticed the revenue 5-year was pretty low at 6.84%. And earnings per share is actually negative. I was like, I do know quite a few people who would consider PepsiCo to be high quality. Then I had a look at the chart and went, ooh, the chart does not look that good. So if you look at the weekly chart, it looked really good until recently. This is the chart of a high quality company until probably a year ago, or maybe even less than a year ago. Share price has been falling. Anyway, so that's PepsiCo. And then we go Advanced Micro Devices, Adobe, Intuitive Surgical, Intuit, Qualcomm, Bookings Holdings, Amgen, PDD Holdings. This is the first one that sort of piqued my interest when I went through this. Yeah, I completely forgot I went through this. And the main reason is because if you have a look at total return, 22.8%, pretty nice. Revenue growth, 71.61%. Earnings per share growth, 61.61%. Free cash flow yield at 12.69%, and P ratio is 9.92. What is this company that's growing really nicely, but could be value? I don't know. I have no idea what this company is. PDD. They probably own something pretty big that I don't know anything about. PDD Holdings, that's the chart. It's been listed since 2018. I don't know. Anyway, the whole point of me doing this was to broaden my horizons, to generate a greater pool of high quality companies. And what I'll do eventually is have a watch list, sort of like a high quality watch list. And when I see some companies on this high quality watch list getting to some good value or in the range of good value, if it made the share price falls below the 200-day moving average, that's when I'll think about taking a position in that particular company. Anyway, so that is what I've been doing over the last 36 hours. Developing this high quality screener. I will still continue to tinker with it. If you have any ideas, I'd love to hear your ideas. So leave your ideas in the comment section of this particular video. Okay, that's all I have. If you have any thoughts, leave those in the comment section. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.